Good morning, everyone. My name is Ray Pearl. I'm the Executive Director of the California Housing Consortium. And I want to thank Lisa Hershey and her team at Housing California for inviting us here today to be a co-presenter for the Housing California Unconference. Co-presenting means to us a chance to highlight our collaboration and partnership with Housing California. Both of our organizations fulfill a niche in the affordable housing space, and individually, we are both strong in certain public policy areas, and our ability to work together, however, makes us even stronger. And I think what we're doing today is highlighting the strength, not only of our organizations individually, but the strength of the two of us together fighting for affordable housing and homelessness issues in Sacramento. I want to once again thank Housing California for welcoming us today with a day focused on education through panels and key public officials. We truly appreciate the opportunity to share a bit in your spotlight. I'd like to now move on to our panel. Our panel today is sponsored by US Bank, and our panel is also sponsored from the California Housing Consortium side, our sponsor, Jamboree Housing. And from Jamboree Housing, our panel today will be led by their CEO, Laura Archuleta. Laura.
Thank you, Ray, and thank you everyone for tuning in today. Again, I'm Laura Archuleta with Jamboree Housing Corporation. Today, we're going to take this time to explore how lending and investing has changed in 2020. As mentioned in the program, the scale of housing insecurity, lack of affordability, and homelessness in California that we have been faced with over the past years has just been exacerbated by the economic fallout from COVID-19. In addition to COVID, the racial injustice and violence, much of which has plagued our country for decades, has been brought to light with new technology, along with an increased lack of concern by the perpetrators to keep their beliefs and actions private as they surge forward feeling supported and empowered. We have a lot to fit in, and our panelists have agreed to touch on all of these issues. To start off, I'd like to introduce Cecile Chalafour, West Division Manager, Community Development Banking with Chase. We also have with us Lisa Gutierrez, Senior Vice President, Director of Originations, the West Region with US Bank. And we have Elizabeth Van Benschoten, Managing Director, Northern California Market Manager, Community Development Finance with Union Bank. What the three of our presenters all have in common, and why I'm so excited to be on this panel here today, is that they are all juggling family responsibilities as we wade through the realities of remote working, as well as most often our children remote learning in the same household where we're trying to do our remote work. All three have a tremendous amount of responsibilities, each in their positions with their organizations. And along with their responsibilities to their organizations comes a responsibility to their clients. They're passionate about what they do, and I'm honored to be curating this panel with them. I will be asking our panelists a few questions and have assigned a kickoff speaker to start those discussions, with the hopes that we'll be able to have each of them contribute on each topic. Midway through our discussion, we will have a poll for you all to respond to, and that will help shape us in our question and answer period. So keep track of your questions. We will be trying to get to them at the end of the session. I'm going to try to watch the clock along with my Housing California helpers. And with that, we'll go ahead and kick on to our questions. So to start things off, I have Elizabeth being our first contributor. And so Elizabeth, can you talk a little bit about how project underwriting may have changed since COVID-19 in this year?
Thank you, Laura, and thank you, CHC and Housing California, for hosting this panel. I'm really pleased to be here along with my co-presenters. You know, this is an interesting question to kick things off because basically we're saying how can you further predict the unpredictable? And I think when you think about underwriting terms, many lenders and investors are already trying to do a little bit of that with some of the guardrails they might put into underwriting a project: vacancy assumptions, expense assumptions, the typical things you see in their pro forma. And what I'd like to say is that I think from what our perspective, we're seeing a lot of those terms are staying the same because we haven't yet seen a major shift in our space. But I think where you're going to start to see more scrutiny, and perhaps it comes up in the questions that you're asked with a project, is really wanting to understand how can a new construction project or an ACC rehab weather unforeseen delays. And so that what that means is looking at sufficiency of interest reserve. It's looking at if it's a tenant in place rehab, is that going to become a real problem and add even more delays? Do you have a plan, especially if you have a tenant in place rehab? And so I think it's really about having partnership with our developer clients. I know many of them will come to us having already thought through this, but I think this is really a new area for us in the underwriting, is delving into that delay aspect. I think the other thing to think about is perhaps where there had been more negotiation about other sources and how they might come in, or the percentage of dollars that might come in. You know, looking at things like upfront equity. Is this really a time where, from a lender perspective, they're going to want to see other folks with skin in the game bringing their money into the project later if it might experience delays? And so really having that full picture and sensibility when you're talking about your project. And then lastly, I would really just ask, I would mention thinking about things like, what is your unit mix? You know, unfortunately, I think COVID has brought about a real unfortunate event of people wanting to pull back from focusing on the portion of renters who might be making have AMI levels exceeding 60%. We were seeing a real trend of trying to solve for that segment of the population. And now, because of COVID and because of concerns about market softening, I think when you're looking at projects that have AMI levels that are 70% AMI, 80% AMI, you know, as the lender investor, you really have to ask yourself, okay, let's say there is a massive recession and the market comps or other comps suddenly become more available to this same renter pool. How is that going to affect the ability to lease up a project? So I think looking at that composition of the unit mix, especially if you're doing things that are perhaps outside the typical 60% AMI limit, will be another area of focus.
Great, thank you, Elizabeth. Do any of the other panelists have any comments on that question?
Yeah, you know, I would say Elizabeth hit it on the nose with the sources that we're bridging during construction. I mean, it's gotten, I would say we're bridging more than we've bridged in a very long time. Some of that is needed based on the bond deals and meeting 50% test. But really, what we saw in a disruption in the last cycle was that some of these sources, not all, but some of them were not as, we didn't feel as sure about them as we did when we started the process or when we needed them for conversion. So I really think that us digging into the sources that are coming in is key. Also, you know, on the tax credit equity front, you know, we are asking more questions in regards to on deals with our trusted syndicators when our funds closing. That's also a disruption of something that we saw in the last cycle. Was you know, who are the end investors on these funds? Are they committed? When is the fund closing? Is there any bridging going on from the syndicator level? Those are the types of things that I think were always important, but even more so given just the level of bridging that we're doing.
And I would just add, I mean, I obviously agree wholeheartedly with Elizabeth and Lisa on all points. I would just add on the perm side and the population type and the rent, we definitely see pressure over 60% AMI. I would say even 60% AMI, we really are stress testing the rents to be at, you know, let's say 25% discount to market, and really trying to size the perm accordingly, or not necessarily downsizing the perm, but we spend a lot of time looking at the timing of developer fee, about who the parties are, to really make sure we don't run into some kind of issue related to even 60% AMI. Because COVID is one thing, but the recession is clearly what everybody has on their mind going forward. And there are definitely some questions about in some markets about how many tenants are going to be able to pay even 60% MI. So when the discount to market is not really big, there are definitely a lot of questions. We saw that in 2008 in some surprising places, including some metros in California, some pressure on the 60% MI. So clearly all eyes are on that.
Mhm. You know, I think that as a developer, those are the things that we're thinking about for sure. 60% AMI, especially in high cost areas where 60% AMI is a pretty hefty rent. We see that with our seniors, and you know, we definitely take a look at it as we're preparing to move forward on development. Our next question is for Lisa to kick off, and that is, how has COVID changed how you look at project sponsors? Who's bringing the deal to you?
Yeah, and thanks, Laura. You know, I don't think that we've really changed our process on underwriting sponsors. We're just maybe asking some different questions and leading the conversation in a different direction and a different lens on sponsor capacity. You know, liquidity, i.e. unrestricted cash in the bank, is always an important factor when looking at a sponsor. Simply put, cash available to cover shortfalls cannot be replaced. I mean, that's something that is really important, and it's something that can help, you know, if there are any unforeseen issues in capital calls. But it's not the only important factor, right? Our sponsors need to be, you know, have access to capital, need to be well connected, knowing the municipalities they're working in, understanding the players in that market and who to go to if there's an issue. So I don't want to put a super importance on cash, because not everyone has a robust cash in the bank, but it is obviously something easy that fixes issues. But I'd also say, you know, reoccurring cash flow is also key. You know, what are the streams of income that support the organization, and how have those been impacted by COVID? Meaning, you know, has the developer fee schedule that you intended at the beginning of the year, has that completely blown up and, you know, and been delayed? You know, are there developer fee installments that you were expecting in order to run your business and the programs? Construction cost overruns that you needed to cover in some way that weren't covered by any other sources? Downward adjusters we're seeing, obviously that's, you know, something to keep an eye on. So those are the types of things that, you know, when I talk about reoccurring cash flow, we're going to be asking a lot of questions about that, especially for folks that are just truly developers at heart, that don't have other streams like property management or construction or other ways that income streams come in. You know, I think rent collections is key. How many times have you all been getting a call from your lender and investor to say, how are rent collections going this month? You know, we're going to keep asking that question. And, you know, and in light of, you know, obviously good news for keeping Californians housed, but in light of the non-eviction bill that was signed late on Monday night, that's something that also I think our developer community is going to be focused on, and we're going to be asking questions about. You know, that can really put a strain on an organization. And so we obviously want to really keep an eye on that. And we want all of you to just be open and honest with us and have conversations, because clearly we want to be your partner. There are solutions. There are ways that we, you know, we have tools in our toolbox, and hopefully that's something that we can work together and talk about. You know, I also wanted to, you know, put a plug in for, you know, our industry leaders at CHC and CHPC who are collecting this information. I encourage you to provide them the most truthful information. I know all of our developers by heart have a lot of pride and maybe don't want to share, you know, want to share the rosier side, but this information is going to be crucial for us to get the support that we need, whether it's from the federal and state level. So I really hope that folks, you know, really take to heart the information that they're providing in that. You know, I think in essence, you know, we're still working with the same sponsors that we've worked with all throughout time. Those who have weathered many storms with us, we're just going to be asking more questions and want to be a helpful partner.
Great, thank you, Lisa. How about Elizabeth or Cecile? Any comments on that question?
Yeah, just to build on what Lisa was saying, clearly a lot of questions coming on sponsor financial strength, looking at rent collection, also looking at the fact that a lot of our sponsor, including in particular the nonprofit ones, have had to cover to some extent some service related costs, and are probably going to do that again for a while. There's also a question about the, conversation about the rents not increasing next year and putting a lot of pressure on NOI, which means most likely the money that goes to support some of the staffing, right? So lots of question on that, and what would that mean on capacity and the level of services too that the sponsor would be able to provide. I would say one of the thing that's a little bit more challenging related to sponsors is all of us have continued to work with all our traditional base. I think we feel really strongly we're deeply committed to be there with all of them. It's definitely a harder time for newer, smaller developers who are trying to enter the field. It's never easy to underwrite a new player, but I would say right now it's particularly hard. And I think we have seen some source of funding that were awarded to newer players, which is good for the field, right? We do want to add new developers who might have a different focus. There has been a little bit of a setback for people to enter the field, at least from my perspective. So we'll have to see how we handle that going forward, because it's actually healthy for the industry in general to have new players, but now it's hard to do.
Yeah, and Laura, I think Lisa and Cecile covered most everything. The one thing I would just add is that I do think it's interesting when you're working on financing a project and you're dealing with a project manager, there may not always be that connection between the project manager who's in the weeds on the project and understanding that we're also looking at the support of the sponsor from a guarantee perspective. And so it's interesting depending on how a real estate development organization is structured. Some project managers absolutely get that. Sometimes we're having to talk more to the CFO to get that background picture. But I think really understanding that there's this nexus between understanding the entirety of the organization's financial health and how it relates to the guarantee on the specific project is key. I would also just say that, we're looking at things, obviously rent collection across the board for their portfolio, but also wanting to understand, does this sponsor have any exposure to market rate units? Do they have exposure to commercial space? I mean, luckily, I think most of the affordable housing projects, you're not underwriting commercial income, but that certainly is a place where you might see a sponsor who gets stressed a little bit more if they have that in their portfolio and those particular assets are experiencing a shortfall in rent collection. And I think Cecile made a great point about services. Certainly we've seen, very heavy services budgets. And if there isn't, a source of support for those coming from an outside source where the funds are committed, that could be another stress for the sponsor.
Mm-hmm. Yeah, those are all issues that we're seeing as a developer and owner of affordable housing. The one thing I'd say is, this is my 21st year at Jamboree, and we have always really focused on the deals and getting the deals done. But wow, asset management, they are the superstars right now, right? Making sure you know what's going on at your properties and you can keep the reporting really tight gets more and more important. And it may not have been as much of a focus in the past. So Elizabeth, you mentioned and you talked a little bit about services. I was going to ask Cecile, if you could talk a little bit about the permanent supportive housing development projects, if there's been any change on how you're looking at those developments. I mean, we really in the last 5 years have seen just a huge increase on focus, attention, funding, and production of permanent supportive housing. And, my hope is we don't see a slowdown in that. And I just wanted to see if you had could kick off thoughts on that.
Absolutely, Laura. I think actually on that side, that might be one of the positive things of what has happened. We at Chase, we have always financed a lot of permanent supportive housing, but I would say in general, it's clear that some of the conversation over the last few months about how technically a project with operating subsidies is very much better than a project without it, and actually deeply affordable projects have, let's be honest, less, strain on potential for lease up, right? We do know the need is there. It's not going anywhere, sadly. So technically, permanent supportive housing from a credit perspective, for the people who know it less intimately, appears now a little bit easier to finance, interestingly enough. So I think overall has happened over the last few months is there is probably a deeper commitment from all parties to support permanent supportive housing, and more understanding of why those projects are actually less risky than they appear to. So lots of really great conversation within financial institution with credit people in general. Not necessarily a major shift, but I would say for the overall industry, a deeper understanding from everybody about what permanent supportive housing actually means. So on that front, it's actually pretty positive. I would say it's all about solid players, right? We all know population in permanent supportive housing do need the right level of services. They need to be in properties where the property manager, all the parties understand the population, are willing to work with the population, and just not assume it's business as usual as affordable housing. It's really important for everybody that those projects be successful for the population who live in it. So clearly, I would say, to the point I made earlier, it's probably not a time where everybody wants to work with new players at the table, right? And to the last point, and I think that's why you were bridging the last question with this one, services are key. Absolutely, in underwriting. I think that has always been the case, clearly, for people who understand PSH. It's not going to go away. I feel for all of us who feel strongly about supporting those deals, they absolutely have to come with the right level of services. Lots of question on funding and capacity for services, right? Because thankfully, we all, there have been a lot of projects being done in California. We're all extremely happy about that. How they're going to work on the long term on the service side, both on staffing and money, is a big question mark. And that's not a detail, right? That's actually at the heart of those projects. So we're all paying attention to that. We're all being very supportive to assume that the funding somehow would work its way over the years. But that's really, as an industry, we really need to pay attention that the resource stay there on the long term. And where I see it play is because the project we know that construction costs went down a little bit, but not in a major way, right? All the costs went up, equity is a little bit tighter. So we see a lot of pressure on underwriting larger perm conventional debt on PSH, including some really creative models where it's really a huge piece of conventional perm debt. And that is put pressure on how much of the NOI will be available for services. So if there are no additional grant or public funds, there is some question about how solid are those deals going to be long term. So I think there's, on the positive side, big commitment from the overall industry to support PSH. I think long term as an industry, lots of question on the service side and how that's going to work to keep those deals very strong over time, and to provide the right level of services to the people who live in it.
Yeah, I would say just hitting on one really important point that Cecile made, experience level and bringing the right parties to the table on a project, on a permanent supportive housing project. We've seen a lot of new players in this arena as of late, and as of funding sources being far more abundant in the permanent supportive housing arena than it has in, say, other types of unit mixes. And I think just making sure if you don't have the experience in permanent supportive housing, there are some phenomenal service providers out there, some of which are on the phone, that you can partner with to bring a fully encompassing social service package to your property. And so again, I just urge folks, and I urge, on the local municipality level, when these funds are being awarded, ask a lot of questions about who these funds are being awarded to, and is the right team in place to make this a successful project? Because the worst thing you can do is fully fund a project, get it built, get folks moved in, and then the services somewhat fall apart, because again, that's a huge mess on your hands.
Mm-hmm.
Yeah, and what I would contribute to this conversation, I had a couple of thoughts on this. One, I think everyone probably, when they're looking at the underwriting on these projects, there may be a shift to move from a 5 to a 7% depending on the population, depending on how the program is being administered. Is there a lag time in refilling units if there's going to be turnover? So just sort of to project managers out there, knowing that's one of the things that we might be looking at when we're looking at this population. I think the other thing to think about is just, I'm very anxious about the fact that we're going to see decreases in tax revenue. Like that is just a fact that's coming our way. And so how is this going to affect the budgets at the locality levels in terms of being able to cover these services? I think many of those funds have been set aside already, so that's helpful, but I think that's something we're going to have to really keep an eye on. And then lastly, something that we saw more of, and it's an interesting philosophical challenge, was, a lot of cities are rightly looking to protect renters. They want to protect them from eviction. That's going to be a big topic of conversation on this panel and also later today. I think you already heard about that in the opening plenary. But, when you are looking at a financing structure and trying to think about how you're going to create different solutions, should a project suddenly experience a challenge with some of its tenant base, typically lenders will look for the ability to, have rents get slightly raised. Maybe you cap it at 60% AMI rents, but you're looking for ways to backfill shortfalls in cash flow. And, we were finding that municipalities wanted to say, zero ability to increase rents on any tenants if it could cause them to lose the unit. And when you start to get into very vulnerable populations, that became a real tension of, well, if that subsidy source isn't there for that tenant, and we can't replace that tenant with a tenant who would qualify as low income, then we have a problem where the project just doesn't work. It's not able to service its debt. And I say it's a philosophical problem because really I completely understand the public sector's position. I think from the private sector side doing the financing and from the developer side, it's a challenge because you then might find you're in a catch-22 of how do you solve this problem. And so I think we have to be cognizant of how the more sources we have coming in, and then we're layering in different public policy interests where you start to find some negotiating difficulty. And I flag this because project managers will find themselves having to do that dance of negotiating between the different parties.
I would want one more point, Laura, if it's okay. Something that came up from what Elizabeth was saying, we're also seeing some developers being very creative with mixing population when there is no operating subsidy for the PSH units. So I have seen some 80% AMI with 20% AMI in the same project, no operating subsidy, and clearly the message is we're having the 80% AMI, subsidize the 20% AMI. The developer should be ready then to address like how they think it's going to work for those two populations together. Not saying it won't work, but be very mindful and have actually thought it through when we ask, what is your experience with mixing those populations in that specific market? Do people in that market who can afford 80% AMI, I guess, will they want to live there? Would they be ready to live there? Do they understand what it is? It's not the same in every market. It's not always, for lack of a better word, a captive audience. So really understanding how the population mix was done, why it's done that way is really important. I would say, obviously, for most of the sponsors, they've spent a lot of time thinking that through. But I have found recently that some actually didn't, not necessarily the most experienced one, clearly. But that they are a legitimate question to really understand how the developer think the property is going to work.
That's a great point. I mean, as developers, we can get really, really creative, and we need to make sure that we think through that creativity, not just getting the project built and leased up, but over the long run. So I appreciate all those comments. So for you now who are watching this today, we need participation. So I'm going to ask the administrators to go ahead and send out a poll. So a poll is going to pop up on your screen. We have 2 questions. So if you can go ahead and answer each of those questions, and then we will, there's the poll, and we'll go ahead and tabulate those responses, and just prior to kicking off the question and answer period, we will report out the results of this poll. So, when we were preparing for this panel, we really had so many items that we wanted to talk about, and I'm seeing tons of questions in chat and in the Q&A box. So this will help us to kind of narrow down really kind of what folks are mostly concerned about through this poll. So we'll go ahead and leave that poll open as we kick off the second half kind of our discussion now. We're doing pretty good on time. So let's see. The second half of this discussion is really going to be focused on what are your most concerns? What are you most concerned about for Q4? So really looking forward. We talked a lot about kind of looking back and existing, but really what are your biggest concerns looking forward in Q4? And you can see that's what our polling's about. And then how do you really see us moving forward? So I'm going to start off, if we can go ahead and take the poll down. So if that means we have to close it, hopefully everybody will go ahead and answer their questions. Thank you. And we will, oh, here you go. Here's the results right now. I didn't realize it was so quick. So there you can see the number one concern for Q4 being residents' ability to pay rent and residents' ability to pay rent on the portfolio. Okay, well that makes it easy, right? That is the number one. I think people are concerned about funding availability from local government, of course, my developer side, my developer hat there, right? Concerned how are we going to continue to build. Lack of tax credit equity, I think we're going to touch on that, as well as services. So we talked a little bit about services. So thank you all for those of you that participated in the poll. I think it gives us an idea of where we should focus our questions and even our discussions in the second half. So, all right, so moving forward, I would like to ask Cecile to kick off a discussion on what trends are emerging in the affordable housing marketplace.
So it's a very complex question, obviously, and seeing the poll, I mean, obviously those conversations about the rents and the immediate impact are front and center, as I think we covered fairly well in the first part of the discussion, how that impacts the lending side. The big other one is clearly, and that came up in one of the Q&A, it's a question on what's going on related to diversity and inclusion and mostly racial justice. So let me address maybe that before we go deeper on other points. So far, I think those questions have come more on the corporate responsibility and philanthropic side of things for, I think, most banks. Because there are a lot of requests and a lot of, we do want to support different organizations involved in racial justice and what that will mean in affordable housing. It hasn't really translated in things we can fund directly as lender or investor, because as you know, there are a lot of rules related to fair housing and fair lending. So it's not actually that easy to say we would, have different product or different appetite for different transactions specifically based on that. But there are a lot of conversation at all levels. I would say at least at Chase, but I'm sure in other institutions as well, on what more can we do. And those conversations get very interesting in terms of how do you look at market strength when you underwrite a deal, right? Because some of it is based on LTV, some of the terms are based on what are the risks long term, what are the public entities involved, and that tends to disadvantage some markets. On the other hand, you have the whole conversation about high opportunities area, and what does that mean when you land in those markets, and what does that mean in terms of cost? So lots of very deep conversation of if we were to find ways to, as lenders and investors, to participate in projects that have a longer impact related to racial justice, what would that actually look like? I don't think anybody has the answers yet, because again, there are a lot of rules that have been set for good reasons over the years, right? That limit our ability to specific target, use race as a criteria for how a loan is made. At least on the multifamily side, that I feel pretty strongly that it's really hard to work around it. But a lot of creativity coming down on that front, hopefully. I saw another question on permanent supportive housing and Project Home Key. and what is the interest from banks and investor in that field. I think what's the big theme, Laura, is I feel there is an appetite for innovation from all the financial institutions. I think we do want to be a player to help to do things differently, not be limited by existing tools for affordable housing, meaning LIHTC and bonds, which, as we all know, are under a lot of pressure, and really explore other type of structure. Then it comes down to what are the developers bringing to the table, right? So for Project Homekey, we actually have only so many requests in terms of private participation in those deals. We have actually not turned down anything, to be fair. I will describe something, some project we're looking at right now, and we actually we're going to provide the financing. There are like 3 motels that are going to be supported by Project Homekey for the services, but not for the, Roomkey, but not for the development itself. So we actually working with a client to do the acquisition, light rehab, and long-term perm financing without LIHTC, and we're doing it. It's very creative. It's definitely outside of what we typically do, but there were a lot of reason why it made sense. So I think that's the theme, is everybody wants to do more for PSH related to racial equity. The big question mark that's taking a hit right now, as we said earlier, is the missing middle. We all want more player, more tools to do more for the missing middle too, because it's putting a lot of pressure on the overall market in California. That's one of the big trends. But right now, as we said, it's harder to underwrite, even assuming the tools were there and the developer wanted it. It's harder to underwrite in the current context. But that's not forever, and hopefully we'll all collectively find new tools to make it easier to do those deals. But that's the big trend, I would say. Innovation is on everybody's lip and willingness to do more. So it's an interesting situation where credit got a little bit, tighter on the box, but there is a willingness overall to do more and different things.
I really appreciate that, because I think that's what we're seeing as developers. I mean, we're having to really rely on one of our core values of flexibility at Jamboree. And I'm sure the developers who are participating, you're being flexible in the deals you're looking at. You're looking for innovation, and you're probably having to do more than you ever had to do in the past. So on top of that, right, we have this racial inequity that is facing us. And I know I have historically been involved with some of the banks on their advisory councils. And I know that Lisa, I have her kind of prepared to kick off even a further discussion on that. And that does seem to be something that's coming up in the chat and in the questions. So maybe we can jump to you, Lisa, on that. If you could talk a little bit about the inequity issues.
Yeah, at US Bank, we're spending a lot of time with our other financial partners out there in the industry on racial equity, really understanding racial inequalities all over the country, as well as tracking outcomes. But, I think what's important and what we believe at US Bank is that this starts from within. This isn't before we can help out and before we can reach the various communities that we serve. We need to be able to understand our own organization and be able to address issues within that. So, this has been a 4-year journey at US Bancorp CDC, which is the umbrella where all of our tax credits are housed at US Bank. We've been digging deep into racial inequality and equity issues, and we've had our senior leader members partake in a 3-day anti-bias, anti-racism training. And most of the employees, I would say, within the CDC have also attended this training that's led by a third-party organization, Crossroads, who we partner with. We believed in that training so much that we've invited our development and community partners to attend that training because we feel like the only way that we are going to make change is to invite other community partners to the table in order to do that. So some of the things that some of the principles at US Bank that we are, have been focused on is that we need to get more capital to Black-owned and led businesses and organizations. And we committed this year to 100 million annually to be giving to these organizations. And we've also taken a different approach to our grants and charitable giving, and we want to address systemic and economic and racial inequities. So we have spent this year 15 million in a rebuild and transform fund. Given that the killing of George Floyd happened in Minneapolis, which is the headquarters of our bank, this was, put directly in our laps in an effort to say, what can we do to help rebuild this community? We also need to partner with community development finance institutions, CDFIs, which have deep relationships in communities of color, and they direct their funds to businesses that are led or owned by communities of color. And so we've given 1 million in grants just directly to Black-led CDFIs to make loans and get capital in the right hands. We also, are making an effort to track outcomes of the projects that we have financed and invested in. How is that, how many Black-led or owned development organizations have we invested with? How many jobs were created at that level, given that we have a new market tax credit shop as well? Really spending a lot of time in tracking those outcomes and tracking that data, because without that data, we don't know what we aren't doing or what we should be doing. So that's something that we spent a lot of time with. And I think now more than ever, it's important for all of us to be focusing on this. And I think at US Bank, we are doing our best to understand, to listen, to engage with organizations in an effort to find ways that we can invest not only our resources, but our time as well.
Thank you, Lisa. Elizabeth, so, I spent some time working with your organization. It's been a few years, but really, I know that how seriously they have taken everything from, you hear a mentorship program, but they really are serious about it. And those programs take years of commitment. And I was just wondering, maybe if you could talk a little bit about what you're seeing and how you see things moving forward at your bank.
Yeah, and I want to actually tee off of something that Cecile brought up, and I think it's something that I've seen in the chat. Really, the fair housing law really dictates a lot about how projects are structured and the populations that are served. Having also worked with the developer, you might have a great vision of how you want to serve teachers or another segment, let's call it a targeted population. And really, once you start receiving federal funds, there are a lot of limitations about how you can target one specific group. And so really, when you want to help enact change and ensure people are receiving benefits, it comes down to, are you ensuring that these populations know about projects that are going to be coming online, that they're getting on those lists for the units that are going to open up, that they're getting on the wait list? Because sometimes it really comes down to community organizing. And so I think this is really important, because when you look at where corporations can help change the system, it's where we're driving our grant dollars. And so, as Lisa and Cecile mentioned, putting that money into the organizations that are mobilizing the communities and helping to work with the developers to engage communities in the resources that are coming online is really important. As you mentioned, Laura, Union Bank has been very passionate about building what I'll call the infrastructure of our industry. So whether it's supporting intellectual debate conversations like these conferences, whether it's looking at training programs, we do a lot of training programs to build the capacity of the field. I would say for a smaller commercial bank relative to my peers on the panel, we actually have put a lot of resources, sort of an outsized amount of resources into that area, given the size of our institution. Specifically as it concerns the social injustice that we're hearing about so much. One of the things that we're doing is we've launched a new community economic recovery program. And this program is really designed to focus on, again, building the layers of support for populations that have been most impacted by COVID, but also by a lot of the racial injustice. And it's looking at putting money into three specific categories. One is trying to really focus on small business recovery efforts, putting $5 million towards that effort, $3 million for rebuilding workforce, and $2 million for financial security efforts. And how does this relate to social injustice? Really, we're hoping that these collective dollars and grants that are going to go out will go towards helping minority-owned small businesses that need more access to capital. We'll focus on training workforce candidates for immediate and longer-term job reentry. And then lastly, that will help preserve affordable housing and provide financial education. So not necessarily focusing on preserving affordable housing as a source for financing a project, but really, again, making sure that populations that have been really left out of the mix are getting access to these resources. So I can't emphasize enough that it is important for the private sector to step up and show that it cares about social inequity. It's important for us to show it in our boards, in our leadership positions. I think it's important as we talk to cities, but I think it's also really important to recognize the network of support organizations that also really help organize communities.
Laura, if I can pitch in on that point too, I would say a lot of the team are very similar to the other institutions, so I won't go over it necessarily with a major focus on small businesses led by people of color. I would add, and I saw one of the question about what are we doing internally. So the mandate from the top has been very clear for us. It's like, this is not a 2 months discussion. This is a forever. We're behind this internally and externally. That's the mandate, right, to everybody. So tremendous amount of trainings and conversation, very different from what it used to be in the past. A conversation where we talk about the reality of what it means to some of our colleagues. Very honest conversation. We have never seen that before in a large corporation. So it's actually quite impressive. In terms of accountability, it's still in discussion how these things are going to be implemented over time. But clearly the conversations are making sure we all hold each other accountable, that it's part of our review process, that it's clear, that it's an expectation ongoing at all level in all businesses. So there's a lot of, I saw the question, but there's a lot of question on how we're going to make sure this never goes off anybody's radar internally. And again, it comes from the top, the mandate is very clear. The one thing I wanted to add that's more specific to our industry is there has been some efforts with support NPH in particular on that, about bringing more developers and leaders to the table that better represents the communities where affordable housing is, and to say it very clearly, that are more people of color. I think our industry, though it's very diverse in many ways, is lacking a little bit on that side. Again, there are some great efforts. I think we would all love to be able to support more efforts on that front. I know for us internally, we're looking at our internship program and be very honest that if they keep pulling from the same schools, the same background, and in practical terms, when people are interviewed, tend to advantage people who have financial knowledge already or training, or real estate knowledge and training. Technically, by default, we're excluding a whole lot of people non-intentionally. That might be the exact people we would want to attract. So a lot of thinking on our programs, internship, analysts, all of this program, mentorship are great, but the way they have worked, they might not have attracted the people we wanted to target. So lots of thinking on how to do this, and specifically, again, not give an advantage to people who have somehow the learning already there. Because when you talk about people who come from different backgrounds, right? If they don't get a shot because they don't know anything about real estate, then you de facto didn't change anything. So that's where I think there's a lot of effort specifically for for real estate and for affordable housing. I see that there's a big gap, and we don't see yet a lot of opportunities to provide support. So we're doing intentionally. We're supporting NPH efforts on that. We would love to see more option on that front.
Yeah, and Cecile, just to put a finer point as well, we need to be intentional about advancing and recruiting Black and Brown leaders within our bank. So we're going to call it, I'm going to call US Bank out, and I'm also going to call out the development community that's on the phone here too. We really need to provide opportunities and elevate in order to create wealth within these communities of color. It's super important. And, Greg Cunningham, who's our Chief Diversity Officer, he says that too many orgs hire for diversity but manage to assimilation. So, you know, when we do hire these new individuals to join our organizations, we also not just to call out that we are diversifying our organization, but really to just welcome and be inclusive of these of folks in our development firms, in our corporate organizations.
Lisa, that's great. The word intentional is really important when we look at these programs. And over time, I mean, I mentioned the mentorship program at one of the banks that I was involved with. Over time, those programs are really, really difficult to ensure that there's some outcomes. And then looking at, as one of our attendees mentioned, like, how do we measure those outcomes? And I do want to say that yesterday was the board meeting of the California Housing Consortium, and we have, and I hope I'm not speaking out of turn, but we have put together a committee to look at these issues and provide some guidance, hopefully, and some leadership through the California Housing Consortium on these injustice and inequity issues. It is at Jamboree, we took on a project at one point where a community wanted to increase diversity of that overall community and had us do some additional outreach in other counties beyond Orange County. And because you know, when we open up a development, and it was touched on the marketing and who are you marketing to, 70% of our initial residents come from that community or those cities that are touching that city. So if you're really looking to change communities and increase diversity within communities that we're serving, and this is obviously a high opportunity inclusionary housing type of development, you're going out and you're recruiting other folks to come in and live at that property. But after a year, we found that some of that increase in diversity was not successful because people are still worshiping outside of our community. They're still working outside of our community, and it didn't work. So to truly increase diversity, it's not just a touch. It's a very intentional long-term commitment. And so I'm pleased to hear that our banks here and the individuals here, because as I say, it always comes down to the individual, that you are all committed to that. I do also want, I think it has to be said that, of course, we have 3 women on this panel. And these are 3 women at large lending institutions who years prior, we would not have seen 3 women here. And I can tell you, after having served on those advisory councils, they are not working within organizations that historically have promoted women up even further in other lines of business. So I really appreciate the work that they're doing in truly breaking barriers. So obviously there's a lot more work to be done, and we're not willing to just settle. But we're really looking for these women to go on to high-level leadership roles, C-level roles. So we will continue to push you. So we do have lots of great questions. I think I've got just one more minute to maybe hit on something that is top of mind before we completely go to questions, and that's really what came out of the survey, and that's what are we going to do if we see folks not being able to pay the rent? And how have you prepared for that, and where do you think we're going? And we've got kind of coupled with that the eviction moratoriums. Maybe Elizabeth, you can kick it off talking a little bit about the eviction moratoriums, and then this concern that folks have about non-payment of rent, and anything you see that can be done there.
Yeah, Laura, gosh, I wanted to also just, hopefully we can also come back to kind of some emerging things we see for the field, because, I was thinking as we're preparing for this panel, we didn't even touch on the fact that the markets were incredibly volatile in March of 2020, and that probably sent a lot of developers scrambling because they might have seen changes in their tax credit equity pricing, commitments. We're seeing lots of different issues there. So I'll just put a pin in that in case you want to come back to that at some point. But in terms of the question about the eviction moratorium, Obviously, there's been a lot of news about this. I think it came out first in the CARES Act and the beginning of this crisis. Obviously, we've got Governor Newsom coming up later in this conference to talk about his new legislation, which does extend eviction and foreclosure protections for renters and homeowners through February 1st, 2021. And then, of course, President Trump had his announcement about the White House and using a provision under the CDC to also offer an eviction protection. I think that only goes through the end of the year, but clearly there's a lot of desire to make sure that politically folks are hearing that renters and homeowners are going to have some protections in place. I think what's hard about this is really understanding what the reality of everything is going to look like. We've been tracking how rent shortfalls have been happening, non-payment, delays in paid rent. And I think we've seen that a lot of the money that came out through the CARES Act actually enabled people to keep paying rent. And so we weren't seeing this dramatic drop off in rental payments right away. But I think it's coming. I mean, this is something that everyone is bracing for. Representative Waters certainly touched upon this. She actually gave a figure of 34% of people were unable to pay rent in August. I'm guessing that has more to do in the entire multifamily rental space versus affordable, because I think affordable has been to date a little bit more buffered. And the reason why I mentioned we don't know what's going to happen yet is that I think everyone's trying to figure out what's their position, right? We got a lot of preemptive inquiries as a bank about, are you willing to forgive loans? Are you willing to make adjustments because of this rental shortfall that we're predicting will happen? And then from our perspective, we were like, well, it hasn't yet happened though. So we're not, to start entering into these complicated document negotiations, we kind of need to figure out what's going to go on. And related to that is figuring out at the federal level, what kind of subsidies are going to flow out there, because that may also stave the problem. And so it's a long way of saying, I don't know exactly how this is all going to play out, but clearly there's a dynamic that goes on between people having the cash available to pay rent, if that cash flow is supporting loans, how that's going to affect the lending community, what kinds of relief programs are going to be offered, what's going to be happening at the private sector level versus the public sector level. And I think everyone's willing to come to the table to do something, but I think because we don't yet have certainty on what's going to happen at the federal level, it's a little harder to put a stake in the ground to say this is what we're going to do with absolute certainty.
Laura, if I can add a point on that, we chose a slightly different strategy, though to Elizabeth's point, we don't have any idea what's going to happen either. Back in April, we immediately decided that on the perm side, a developer would just have to request and we will grant 6 months of forbearance. We specifically did this because we did not want to have to look at the specific of what was happening on a deal, what was in the documents. Of course, all the parties to a deal will have to agree, right? But for obvious reason. But we decided that on the perm side, we would go with, if the developer is asking because they're under pressure, we'll automatically grant those 6 months to keep it easy and simple. To Elizabeth's point, we have had a lot of inquiries. We haven't had really real ask to speak of because nobody has really seen a drop in rent collection yet, or not substantial enough, right? Not substantial enough for people to ask for this. I think the big question mark is it's only pushing the payments, further, right? Like the big one is like, if this is going on for a very long time and indeed people cannot pay the back rents and the landlords are really struggling with it, what's really going to happen is the big question.
Yeah, and I would just say, urge folks, again, as I mentioned before, there are some industry leaders, CHPC, CHC, they're working together to gather data. The only way that we're going to affect change in an effort to find some type of federal or state relief to help with this, if this actually continues, because this is the first round and there could be a second round of non-eviction rules that are in place that may look a little different or exactly the same. I just encourage you all to, when you get the request to share info, to be honest and open and share that info. I think that's the only way that we are going to be able to affect change, is to provide real data about what's going on at our properties in an effort to keep this industry alive.
Well, great discussion. And I think we do have to come back to the equity question. There's lots of questions coming in about if we have more and more projects moving forward how do you see the demand to provide equity, and where do you see pricing going? And do you have concerns that there won't be equity out there for developments? And I throw that out there. I don't have anyone keyed up for that one. So any of you that
I'm happy to kick us off.
Great.
So, it's interesting. What I can say is that as I mentioned, March, we had a lot of volatility. Fed rates were cut. We saw LIBOR going to near zero. I think for banks, that creates a lot of stress because it affects the interbank lending and predictability. We were very proud to stand behind our equity pricing and our commitment to equity. And so I think that remains our position. We are not the largest private or direct equity investor in the marketplace, but we certainly, on the projects that we are investing in, we are committing to hold our pricing and to be there for the clients.
And to speak for our equity partners, because that's not my expertise, I'm on our lending side, but I will say that we stood behind all of the projects that we had signed up. We continued to sign up new projects even after March 11th and the pandemic was declared. What is next year going to look like? We are still working on that. I know all of the banks are conferring, setting up budgets and whatnot for next year. But I will tell you, there's still a ton of variables out there. We have an election. We have so many things that are really up in the air for us to be able to really talk about how next year is going to look. To be honest, I think that pricing held fairly well. I may be the only one who's saying that here. Maybe my panelists agree with me, but maybe the audience does not. What it'll mean for pricing next year, we'll see. Again, so many different variables out there. I know that, none of you are looking for a cagey answer, but we really are watching day to day. There are changes, and we're just going to keep watching that. But I will tell you that US Bank is committed to our affordable housing group, both on a lending and investing side of the house. In the worst of financial crisis, we were still investing and lending. So I know we have a commitment to the communities we serve, and we will continue to do so.
Mm-hmm. And I would say I'm only on the lending side, so I cannot quite speak for our equity people. I would just say overall they have been extremely popular this year, as we saw some smaller investor not quite as active. So I would say that, and we have held our pricing fairly well. I would say, to be fair, I would agree with Lisa, considering everything else. Yes, there has been, it's lower. I would say overall we see it on all transactions that it was. But surprisingly, it's not even lower, I would just say. The big question mark is there are a lot of transactions. And there are some really, really big ones coming down the pipeline, and very few banks can do those. We're one of the ones who can, and there's going to be only so many huge transactions that can go forward. So I think that's the big question mark, to Lisa's point, in addition to everything else, right? A lot of questions. The firm is really clearly committed to keep doing a lot of investments. But again, how that's going to play at the deal level is a little bit unknown. Clearly, there are less players at the table, lots of deals, lots of demand. What does that mean? Plus, we're also keeping our eyes on the CRA modification. So there's a lot of questions all around the place, but the commitment is there for sure.
Mm-hmm.
Yeah, Cecile, great point. Sorry, Elizabeth, great point about CRA. A lot of the larger institutions are starting their CRA cycles over next year. But then also our federal government passed this year some sweeping CRA changes. Will that change if there's a new administration? We don't know. Again, just part of the many variables out there on what we're all trying to digest through a fire hose, because all of these changes have happened so quickly.
I was just going to say, I'd like to put a plug out there also for the syndicator community. I mean, I think there was a big trend to have direct investors on projects. Those direct investors were demanding the debt, and that was becoming a very siloed way of financing projects. And now we've had this tremendous rise in construction costs. The projects are getting more expensive to build. So suddenly you're looking at equity investments that aren't $25 million, dollars. People are asking for $40 million northwards, which becomes really hard for a direct investment strategy. I think that lends itself to syndicators having a greater role in the marketplace. And then lastly, you know, as we've seen pricing come down from maybe over $1 now, you know, that definitely, I did see a dip in what pricing was being offered to developers. You know, I think that gives syndicators a chance to perhaps step in and to play more of a role in transactions. So I would just encourage people who are working on projects, it might be time to shift that mental model of I'm just going to get a direct investment, and to think about which syndicators am I going to include in the RFP? How am I talking to them? How am I building my base of other sources of capital? And of course, we need to get other players into the investment space. Financial service firms motivated by CRA, we know it, but it's time to get other folks back in here because we need more of that capital. And I think that was the same pressure we saw with the rollout of the state tax credit program. We need to have other, you know, look at who's dominating the stock market. You know, we need to get these other firms, other industries into the investment space more.
And I would just say, given the heightened focus on racial equity issues in our market and how focused every organization, large corporations are on this, I think now is likely a time to act. To put a finer point on Elizabeth's non-financial service investment pool that we could be drawing from.
Mm-hmm. Yeah, definitely. No, those are some great points. One of the issues that has always been a concern of mine, and folks that know me know this, you know, my background is in the criminal justice world. And we have a question that popped up from Linda Mandolini, which I did not know that that some of the banks, and maybe Cecile, you can comment on this, is Chase specifically looking at ways to be involved in helping people who have been part of the criminal justice system? And is there a social equity component to that Chase is trying to get after?
That's an excellent question, Laura. So yes, actually, that came from the top, right? A couple of years ago, as like, this is absolutely a priority. I think we all know, unless we tackle that, there are some population that will never get the help they need to really change their life. So the whole focus on the reentry housing challenges it's clearly a mandate we got. So far, that has been something that philanthropy has been focusing on because that's where the requests came. I think the big question now, and I know who asked the question, and I'm guessing that's what's at stake here, is how more can we help? Meaning we need projects to come our way. We need to be asked to be creative around those, because technically the financial institutions do not drive, right, which projects get done and what makes sense to a developer or an organization. We would love to see more on that front, and we're willing to help. Absolutely. How? Again, we need to see what that looks like, what the specific ask is. But I do think that when we talk about diversity and repairing some of the damage from, you know, the challenges on the racial side of the years, that's key. We all know that. So we know it's hard for the light tech developer, which tend to be our base, right, in community development, to really tackle maybe those projects because maybe they're smaller, they're not the expertise. But we would love to see more joint venture with some great organizations out there who are doing the work, but don't have the development expertise. So I realize I'm not being very specific in terms of what we have done in terms of those projects, but we need to see them come. So far he has been more like supporting on the philanthropic side, but we would like to see deals actually being done. And we will find ways to underwrite them if that's what it takes, right?
Yeah.
Right. And I think that's where the joint venture comes in. We know the numbers are going to look different. We know they're all going to look different, but we definitely have an interest if the project makes sense from a real estate perspective too.
And we financed a project not in California, but up in Eugene, Oregon, that was first preference to formerly incarcerated individuals. So there is a model out there, you know, obviously getting past all of the red tape, the NIMBYs, you know, every single all of the grit and perseverance that developers have when they're trying to set forth on these projects. But there is a model out there that's successful. And, you know, again, this really also speaks to the racial equity agenda as well. So I think it's something that all of the banks would likely be open to and finding a way to lend and invest to.
Mm-hmm.
Yeah, absolutely, Laura. I mean, I think we're relying on the developers to kind of tee up those projects, but I can't see any reason why this wouldn't be something that we'd want to finance. I will say, taking off of my project financing hat, you know, I sit on our area foundation committee, and I'm very involved here in Oakland with a group that's really helping to look at what the city initiatives are coming up with around looking at just problems where you've got you know, populations that are, you know, entering the criminal justice system, you know, looking at things like how if you've got a group of people who are getting more parking tickets or other things, how this is kind of piling on. And so I would just say that to the extent that our corporate entities are able to use their dollars to also help benefit city initiatives. I mean, a lot of the city staff are very close to seeing these problems, and they actually might be able to better generate some solutions. So I think it's about, again, not necessarily having the bankers come up with solutions, but certainly making capital available and certainly looking for other areas to grant out money where you can bring forth some of the best ideas and thinking.
Well, I appreciate those comments from all three of you. And I know that as a community development organization and many folks who are watching, you know, we care about this issue. And I do want to encourage other affordable housing developers to reach out to those nonprofits that are in your communities that you serve, that work with maybe the youth authorities and the folks who have been incarcerated, oftentimes at such a young age for you know, incredibly limited crimes, if any crimes, and are having a hard time getting back into society. And so affordable housing is really one of the keys to breaking the cycle and recidivism. And so I think it does fall on not just the lenders being willing to step up, and we do appreciate that, but to us affordable housing developers to reach out into those partnerships in our community. So I do believe that we are out of time. We have a tremendous number of questions that we didn't get to. So I'm hoping that our staff who are staffing all those questions can put them together, and maybe we can just individually email back some thoughts. But I do want to thank all of you panelists for being with me today. You guys did a great job, and encourage you to continue to break barriers and weather through COVID and everything that you're facing as you wear the many hats that you do. So thank you.
Thank you.
Awesome. Thank you, Laura.